Hello, welcome again. And in this video, we will solve a problem of trading securities and fair value adjustments. Okay, so fair value adjustments. So fair value adjustments means that sometimes you have purchased some securities and the fair value of the securities may be uh, more than your face value or less than your face value. So the difference should be adjusted. So that is what we call the fair value adjustment. Okay. So now let's solve this one because I think that example is always better than lots of words. So solving this problem will give us a clear idea of how to record the trading securities and the fair value adjustments. Okay, so now let's read the problems first. So a company acquired a long-term investment 240 million of 6% bonds dated July 1, 2018. The market interest rate was 8% for bonds of similar risk and maturity. So the company paid 200 million only for the bonds. See that the price was 240 and they paid only 200. Okay, so it was on discount. So the company will receive interest semi-annually on June 30 and December 31st. The company is holding the bonds in its trading portfolio, meaning it is a trading security. Okay. As a result of changing market condition, the fair value of bonds at December 31st, 2018 was 210 million. So what we need to do? So the first one, prepare journal entry to record the investments on July 1. So here is the template on the Excel template. So let's see how to record the investments on July 1st. Okay, so it should be very easy. Investment in bonds, the face amount. Okay, and it should be 240 million. I am writing all the amounts in million. So, and they paid only 200 million, and the difference is the discount on bond investments. Okay, so let's write it down. Discount on bond investments. So to record investment in bond. Okay, the second one is, it is saying prepare the journal entries to record interest on December 31st, 2018 at effective rate or market rate. Okay, so now let's see how to record this one. So from our previous example, we have seen that we need to calculate the semi-annual interest rate, and there are differences between cash and effective interest rate. So let's see the cash we will receive. So 3% of 240 million. Okay, so it should be equal to 240 multiplied by 0.3, 7.2 million. Okay, and effective interest would be interest revenue, and it should be 4% of 200. 4% of 200 million. Correct? Okay. So it should be equal to 200 multiplied by 0.04. Okay, 8. Okay, so the difference between these two would be our discount amortization. Okay, so that is why we say discount on bond investment. Bond investment, so it should be equal to 8 minus 7.20, so 0.08. So let's use decimal places, so 2 decimal places. Okay, and now number 3 is saying prepare journal entry to reports investments in this on December 31st in the balance sheet. Okay, so first thing is fair value adjustment. We need to do that. Okay, so for that, so let's see, face value of the bond is 240 million. Then bond discount on bond investment. What is that? So it should be say discount on bond is total. How much discount we have? See, this 40 million. So 40.0. Okay, and then what we need to do? We have amortized already 0.8 million. Okay, so discount and amortization we have 80. So what do we need to do? So the difference between these two, we should find the difference between these two, and we will subtract this one. So after subtracting, we got the amortized cost of bond, and that is equal to 240 less this one is gonna be F17. Okay, so let's close this. And now you see that as a result of changing market condition, the fair value of the bonds on December 31st, 2018 was 210. So the fair value of the bond is equal to $210 million. Okay, and less amortized cost of bond, which is equal to 200.80. Okay, and let's underline. And the difference between these two is our fair value needed to be adjusted. So this one is equal to 210 minus 200.8. So 9.2. So what is that? See, our amortized cost is 200.8 million and the fair value is 210. So that is why fair value is more. So it means that we have a gain. So what we need to do, fair value adjustment debit, which is 9.2, and unrealized holding gain, net income. See that? So unrealized holding gain would be reported to net income. So the difference between trading securities and held for available for sale security, the main difference is here. So I'll tell you more. So the difference is, see that here what we have done, unrealized holding gain will be reported in net income, but in case of available for sale securities, this unrealized holding gain will be reported in the under the head other comprehensive income, which is more commonly called OCI, other comprehensive income. Okay, And now let's see, we have number 4. See here, what we need to do, we need to update fair value adjustment. Okay, why? Because the fair value has changed. Okay, this one is on December 31st. Okay, and this one is on January 2, 2019. So at this time, what do we do? Amortized cost is 200.8 million. Okay, less fair value. The fair value is 190. Okay, so in the line, then unrealized loss, it should be equal to 200.8 minus 190, so 10.8. And now we have another thing. See that in our previous, on December 31st 2018, we had a $9.2 million unrealized holding gain. Now we are having a loss, total loss of 10.8 million, and we are foregoing, meaning we are forfeiting a loss of 9.2 million. Okay, so loss of gain recorded ever. Okay, loss of gain, and that is 9.20. So our total adjustment, we need 10.80 plus 9.20. Total adjustments we need, so total 20 million. Okay, so fair value adjustments needed total. So on January 2nd 2019, our entry should be unrealized holding loss. Okay, and this should be reported in net income, so we are writing NI, net income. Okay, and it should be 20 million and fair value adjustment, okay, of 20 million. So this is how we record. So thank you so much.